So we are just gonna look at what's going to happen. Okay, so this is not a live trade. This is not a live trade. We are not doing anything live. We already have a ongoing trade, which is the S&P 500 for this particular session. This one. Okay, so the trade already went up yesterday lah. So it's either you are in this trade by like just now, or if not, right, if you want to like go in right now, I don't know lah, up to you, okay? But make sure you read and you know your trade plan. So this is not a YOLO trade, okay? So be very clear what you are going to do. Wow, I have Kathleen Desmond. Good to see you guys up until like 1:30 a.m. For me is not normal. I usually sleep at 2:30, 2:33 like that. And then the next day I will wake up at like 8 a.m., 8:30 a.m. like that. Short, just half an hour before Singapore market open. Okay, so before we start, right? Before we still have about 20 minutes. Let me, for those uninitiated, don't know what's going on, right? Let me walk you through. So FOMC have about, I think every year they hold about maybe 4 or 5 meetings, I forgot already, where they will decide the interest rate, which tends to affect the market a lot, especially when there is some expectation that interest rate is going to move up or move down, and the market tends to get very, very violent. So we have one meeting in March where Federal Reserve raised the rate by 0.25%, 25 basis points. And then prior to that, we have the entire market falling down, mainly because sometime in late December, early Jan, right? Federal Reserve say that they are looking to raise the rate. So that's why you see somewhere around here, we have the market falling down, okay? So eventually when they raise the rate in March, the market kind of rally, because like it is more like when Federal Reserve they say they want to raise the rate, right? The market kind of like panic lah, then sell down lah. But when they actually raise the rate, it's like everything already come down lah. Okay, so currently we are like in a very similar situation. We have Federal Reserve sometime in April saying that they not only want to raise the rate, they want to raise it higher, because previously the consensus is that they are going to raise by 25 basis points, okay, 0.25%. But in early April, right, Jerome Powell came out and said that maybe in May, right, they may or may not raise by 50 basis points. So instead of 0.25%, they are going to raise by 0.50%. So it seems that now 0.50% is on the table. There's a possibility there. So that makes this Federal Reserve, this FOMC meeting that we are having today, very, very special. It is extremely special because if you look at all the past history where Federal Reserve raised the rate, right, there is no point since 2008, since after the housing market crisis, right, where they raised the rate by 50 basis points in one session. They have never done that before. Every time they only raise by 0.25. So let me show you the data all the way from like 2010 like that, okay? So from 2010, you can see that you look at this column, you look at this column, okay? This column is the actual column. So you can see that most of the time, the rate remained steady at 0.25, 0.25, all the way 0.25 until sometime in 2015, it was raised from 0.25 to 0.50. So it was a 0.25% raise, okay? So it's a 25 basis point. And then after that, it remained at 0.50. And then it got raised to 0.75. So it is still a 0.25%. Then 0.75 got raised to 1.0, 1.0 got raised to 1.25, then 1.5, then 1.75, then 2.25, 2.5. Then you can see the pattern lah. It is always raised by 0.25. We have never raised the rate by straight away 0.5 before. So this session is very important because Federal Reserve is raising 0.50 point since the housing market crisis. Okay, so now currently we are at 0.50. So the expectation is 1.00, meaning we are gonna raise by 0.50, which is why it is quite historical moment lah, I will say. So the key thing is it is the expectation. It does not mean that guaranteed chop 0.5, but it seems that the market already priced in 0.5 lah, which is why we have such a big drop recently. Okay, so the market kind of like priced in 0.5 really. So a few things can happen. The first thing that can happen is, number one, Federal Reserve raise the rate by 0.5. So this one is expected lah. This one is what market expected. So if Federal Reserve raised by 0.5, right, I think market can still rally, mainly because I think here we are kind of like oversold already lah. So the market expected 0.5, but there are a lot of people selling. So there's some selling momentum, like which caused the market to fall way lower than it should be. So when the Federal Reserve actually came out and say, okay, they raised by 0.5, right, perhaps market can do a relief rally. So at some point it will create a lower high and then start to go back now. So now we are trying to catch the relief rally. Okay, so this is what exactly happened here, where market went into oversold, but they already know that in March, right, Federal Reserve is going to raise by 0.25. Everyone know that already. So when it eventually raised by 0.25, right, the market kind of like went up lah. But the more important thing is that Federal Reserve also want to reduce their balance sheet, and the reduction of balance sheet will remove the liquidity from the market, and it can have negative impact on the stock market lah. So now we have two factors. Number one, how much are they going to raise the rate? And number two, how aggressive are they going to reduce the balance sheet? Because their balance sheet is quite big, and depending on how aggressively they want to reduce, right, it can cause the market to dive or what. So we need to consider the second factor also lah. Okay, so but if Jerome Powell just raised the rate by 0.5 and he doesn't mention anything about the balance sheet, right, then maybe market can rally lah. Okay. Another thing we also have to consider is that last week US GDP came out and it was negative 1.4. Negative GDP is very, very rare. We only face this during recession, or we only see negative GDP when we have a very challenging economy lah. But so far, it seems like the economy is not really challenging yet. It's like everyone got a lot of money, all the housing price go up, all the COE price go up, like all the people, the money fall down from the sky like that. But despite that, right, we have a negative 1.4% GDP in the US, which is kind of a little bit alarming. So maybe this GDP, this negative 1.4% GDP might trigger Federal Reserve to raise the rate by only 0.25 instead of the expected 0.5. Okay, so if Federal Reserve only raised by 0.25 because of the GDP issue, right, then market confirm guarantee chop gonna rally up very, very high already. So this one don't even need to see anything else. But I think it's rare lah. I think the FOMC won't rate. They won't go to 0.25 lah. Although the possibility is there, right? I think it is kind of not probable, possible but not probable. Then we also have the other extreme end, which is raising by 0.75%. Now we never raised by 0.5% before since housing crisis, right? And if Jerome Powell decide to go crazy YOLO and raise the rate by 0.75, right, I can tell you the market will jump down already. I think the market will straight away probably break the 4,000 point by tonight lah. So if that happen, right, we will immediately switch to short position. We will clear our long and immediately switch to short position already. So we don't even think already. Okay. So the most probable is they will raise by 0.5, but if they raise by 0.5, we have to consider what is he going to do in the future, because now they raise by 0.5. What about the next meeting? Are they still going to raise by 0.5 or will they drop back to 0.25? And how aggressive are they going to reduce their balance sheet? So these are the things that you need to pay attention to what he is talking, okay? So this is the skill that you learn during primary and secondary school, listening comprehension, okay? So not everything is just come here, look at the number, and then after see the number already, you buy, sell. Trading doesn't work like that. You must know how to listen. You must learn to listen. Even when during earnings season, right, when all the earning results come out, right, a lot of people like to take the shortcut. You know what is the kind of shortcut that people do? And then like after that, they get confused. They have no idea what's going on. Traders like to come here and then they see this one green color. They say, hey, earning big ready, and then very happy, but end up the price go down. So it always earning big, then price go down, and they start to wonder, hey, why? But actually, even though the company beats the earning, right, they are projecting a lot of negative outlook for the rest of the year, and market doesn't like that, so the price come down. And we have a lot of this kind of situation during this earnings season. We have a lot of counter that have beat the earning, but the share price still fall very low because of the fact that the outlook for 2022 is not very good. And all this outlook, right, they only mention during their webcast. Webcast is like the CEO or whoever the representative, they will come up and they will say some of the stuff that they want to say, like it's like a AGM like that lah. So sometimes reporters will be there to ask certain key questions, which you can listen also. You can see AMD, very good earnings, but drop down already. So for example, I can go to AMD Investor Relation. And then here. And then you can actually, no, this is the March one, but never mind, it's exactly the same thing. You can actually listen to their webcast here, the audio file. You can even listen to it live. Okay, so now that we know what's going on, let's look at the calendar. In 12 minutes, we are going to have the federal rate decision. Oh my God, there's 19 people. Seriously, you guys don't sleep one. Price in is 0.5. Price in is 0.5%, meaning is they are going to raise 0.5% from the previous 0.5. So the forecast now is 1 lah. I mean, the current rate will be 1 lah if they raise by 0.5. Okay, if they raise by 0.25, then we will have 0.75 instead of 1.00. Okay, so the rate decision is coming out in 11 minutes. But the press conference, right, it will come out slightly later in 41 minutes. Initially, it was like 2:30, but it seems like it's only going to come out 3 a.m. So this is where the FOMC, Jerome Powell, will start giving out his statement, his speech, whatever you want to do, okay? So that is where most of the important stuff will happen, but probably by then, I think 3 a.m. already lah. I don't think I will be up lah. Okay, so it's quite risky. It's quite risky if you are trying to play within this session itself. So I suggest you have a proper plan. Okay, set your stop loss, everything, do nice before you go to sleep. Okay, for example, the rate decision come out to be 0.5, meaning they raised to 1.00, but during the conference, they started saying things like they want to reduce the balance sheet aggressively. They are going to continue to raise by 50 basis points in all the remainder of the meeting, right? Then maybe market can start to U-turn. It will be very volatile, okay? So let's see what we have. So for the earlier of today, right, we can see a little bit volatile, You can see that price, when market open, it dive, and then sometime around 11:30 p.m., right, it recover. And then now, I think it is just hanging around until the decision come out. The moment the decision come out, you're going to see very big swing, okay? So let the big swing happens. I set 2 alert based on the chart structure. One is below this support, one is below this resistance. But of course, I'm not using these to make trade decision, but rather I just want to know which side is it, okay? So in terms of the longer trend, right, longer trend chart structure, we are still in a bearish. I mean, it is still a downtrend, okay? So what we are just simply trying to do is to see whether if we can get a rebound, we rebound towards 430 like that. Simply because, right now, a lot of the counters have fallen so far that there isn't anything we can short at the moment with very good price level, mainly because everything have fallen so low already. So while waiting, right, we can try to get a quick long position on the rebound. Okay, so wow, Pool Corporation is like diving head first. It's gonna close the gap already. Congrats to whoever's still holding this. Like for example, if you look at some of the counters that I want to short, right? If you look at Snowflake, like already at the bottom there. And Shopify also I want to shop, but it's like at the bottom there. And Rivian also like already like somewhere there. Starbucks, it went up by 8% today due to some earnings. I don't know. See if you see here, right? They missed the earning, but the price still go up, But I mean, this gap up is I would say expected because we have fallen so low already. So I do expect some kind of relief really. But maybe if this kind of like cap out somewhere, right, we can reinitiate new shots also on Starbucks also. Something like Snowflake like that. We can reinitiate new shots here. So we don't really have any we have target counters that we want to short, but it is just that they have fallen so low that it is not safe. Nice Swift actually tries to rally, but now a red color. We also have Shinari Energy. early morning gap up so high, but it's good to see this recovering. It's good to see this recovering. Somewhere near our entry price. Hopefully can go up some more. Then on all the big techs, right? AMD, very strong earning result, extremely strong earning result, but market is selling into the strong earning, which is quite bad, quite bad. We have Google kind of like struggling at the bottom there. I put my alert level there, but still haven't hit. Amazon, very bad, very bad. Okay, so we still have all these counters surviving. Apple kind of recover a bit. I think Apple and Microsoft is like saving the entire index. Tesla is lagging. Okay, so we are stagnant there. So let's just wait until the result come out. 6 minutes, very exciting. Let's listen to what they have to say. Yeah, Amazon still dropping.
This becomes a big issue as they get to neutral and now policies no longer accommodative. But right now, with inflation as high as it is, an unhealthy labor market, as Chair Powell put it, I think the reaction function right now is let's get to neutral and let's get there expeditiously, which is the word that they're using. So I don't think financial conditions, I mean, they're doing what the Fed wants it to do. I'm sure they're moving much faster than the Fed would have liked, but I don't think the put is here right now, given inflation.
Bria, we're also looking at how much longer term, I believe that we're still hearing Michael Verrilli there in the background, but Bria, there is this concern about how high they can go with respect to the dollar being an international body and being basically the central bank of last resort. Do you think that there is a conversation eye toward the international zone and the disruptions that we're seeing in certain markets with the weakenings of other currencies and the inflation crises there? Is that on their radar, or does it not matter because inflation in the US is in the forefront?
You know, I think the Fed has a dual mandate, and it's a very domestic dual mandate. So I'm sure they look at international developments, what's happening in China and Russia. I mean, all that is impacting US inflation, which the Fed is trying to bring down. So I'm sure they're looking at that, as well as what does the tighter dollar mean for financial conditions. But given how high inflation is, and the fact that they've only raised rates once, I think right now all this is much lower in terms of the priority list. The key is let's get to neutral and let's try and keep inflation.
The 10-year yield is gonna like it hit 3% lah. It hit 3%. But now it's like retracing. But I think the moment the rate decision come out, right, it's gonna just chung all the way. This is very scary. 10-year yield at 3%. Oil price is going up. And for today, right, home builder minus 1.36, worst performing. Energy, best performing. Tech kind of like don't know what's going on there. Semiconductor is red. Financial is green also, probably why the in S&P is green. Because if you look at NASDAQ, right, NASDAQ is actually red because NASDAQ is all the tech companies lah. S&P a little bit more balanced. You have industrial and financial kind of like carrying a bit of the load. So even if you have all the tech counters red, right, as long as your financial are green, the index tends to be doing quite okay lah. For example, let me show you. Like we have the heavy hitter like Amazon is still red. But as long as your banks are green, right, I think S&P is somewhat okay lah. But for NASDAQ, right, if your tech is all red, the entire NASDAQ is red already. That's why when the tech sell down, NASDAQ usually down like 2%, 3%, whereas S&P is only down like 1% like that. Dow Jones is a little bit more stable, but they don't move a lot also. The bad thing about being stable is that when it is in the growth stage, right, S&P and NASDAQ will move a lot higher than Dow Jones lah. Because all the companies inside Dow Jones are mature companies. It's called the boomer index lah. Because you have all the Coca-Cola, Microsoft, I'm not sure General Electric is still inside or not. Pfizer. Where are we on the timing? 2 minutes. 2 minutes. When it move up like this, right, I'm a little bit scared. Because usually it tends to like goes the other way. If it move down, right, I'll be a little bit more it's like playing casino, right? My position all settled properly. Oh crap. 1 minute.
Yeah, and hopefully one day we'll find out what that is. That'd be nice, wouldn't it?
It's going to be interesting to see. Kevin, you run from that question. John, this is exciting. And I really go back to 94 or, obviously 2000 as well. But it's been said so many times, I think we've become numb to it. A 50 beat move is a big change from a measured cadence that Alan Greenspan invented.
I agree. But you know what's a bigger deal? It's the reason we're here. It's because so far, Lisa, as you pointed out, we've only had a 25 basis point hike. And they are down where they are relative to where inflation is at the moment.
That's where I really am trying to understand what the market believes about the Fed. This has been a dovish Fed for so long, for more than a decade. Do we really believe
you can see here, okay?
About face to understand that they need to be overly hawkish compared to the market's expectations in order to tighten policy? Do they have that willingness at a time when there's an increasing number of people talking about recession?
I think Bramo's questioning the Fed's pivot here, TK.
Well,
Just a little bit.
I think that the market is.
I'm going to cut them some slack. Did these guys deliver, these men and women, did they deliver a fully employed America? To me, that's the heart of the question.
You're cutting them some slack.
I
Did
don't
they deliver a fully employed
There's so much to
America
say.
at 3.5% on Friday?
He can see the clock, Lee, so he knows it's only.
This is like the longest 1 minute. What is it? Where's my decision? Holy crap. So what? Wait.
Going back to the year 2000, going into it, your equity market looks a little something like this. Up 0.4% on the S&P 500. On the Nasdaq, we're doing okay. Up 0.4% also.
1%.
The bond market yields have been surging higher, much higher going into this one.
Okay, so it is as per the expectation now. Okay, they raised by 0.15, but you can see how crazy the market is swinging. If you are some YOLO trader trying to do funny thing, you confirm get swing out here. But let's let the market settle down. I mean, we don't trade on this kind of time frame. We already have our trade position already done properly. Okay, so let it play out. Okay, let it play out. Let's listen to what Michael McKee is saying.
Pressures. Russia's invasion of Ukraine has unknown implications for the U.S. economy, they say, and related events are creating additional upward pressure on inflation, likely to weigh on economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. The committee is highly attentive to inflation risks. And so the decision to raise rates by a 0.5 percentage point for the first time since May of 2000, they say they anticipate that ongoing increases in the target range will be appropriate. They add the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The decision unanimous this time. As for the balance sheet, the Fed says it will start letting Treasury and mortgage-backed securities roll off mature starting on June 1st. They will cap the amount they can roll off in any 1 month at $47.5 billion initially, 30 in Treasuries, 17.5 in mortgages. Those will increase over 3 months to 60 and 35 for a total of $95 billion. That's the figure that had been given in the minutes of the last meeting. Back to the language they used after stopping post-financial crisis QT, they say they intend to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves.
Mike McKee, let's whip through this price action. Equities with a little bit of a lift here, up 0.7% on the S&P, on the Nasdaq, up 6 or 0.7% also. A curious move in the bond market initially, had a bit of a rally, yields lower at the front end, started to price out just a little bit from the June meeting. Mike McKee, then we come back again. 2-year yield unchanged at 278, still in and around the highs of the year. Has anything changed from what we've heard so far, Mike, that would lead you to change your question that you had prepared for Chairman Powell in 30 minutes?
I'm sorry, Joe, did you ask me?
I did, Mike. Is there anything new in this relative to what we expected coming into it all?
No, the interesting thing is, I almost started off by saying you priced it in, they delivered. The Fed gave the market what it was expecting. And we were talking earlier on your show about how the Fed is sort of front running itself. It's telling the markets what it wants them to do. And at this point, they seem satisfied with the markets adjusting to a regular rise of about 50 basis points. No suggestion in this statement of 75.
Michael McKee, we were talking with Dr. Ferroli over at JP Morgan about the two parts of the American economy, the domestic part and export, import, even the inventory build that's being discussed. That trade balance number today was a wow statistic. How apart is this economy that Chairman Powell faces domestic?
So we have close to a 1% swing now. Okay, so you can see how aggressive the swing is. So it's very important that if you are holding your position, right, don't hold very big position with very high leverage, because this kind of swing, if you have very high leverage, right, you can see your account swing like don't know like what, and then your heart cannot take it. For me, right, like I don't have to look at my position. I just see the swing here. I know how my position will be like. So imagine if you have a 10K account, right? If you have a 10K account and you play very big position, within that 10K, your position can swing like 2-3K like that. And your heart will beat very fast, because it's either you're gonna like double your account or you're gonna lose like 50-60% of your account like that. Okay, so be very mindful of your position when come to this kind of thing, especially when you are on CFD, the index CFD, which have like 5%, which only require 5% margin. That means like you have 20 times leverage, which is a very high leverage. So you can see it's kind of like stuck there. It is just trying to play out like all the seller selling, all the buyer buying. So they are just trying to play out. So the key thing here is your trade, right? Whatever trade plan you have, it should not be triggered by this kind of movement, meaning you are not supposed to wait for this kind of news and then see which direction and then go and buy or sell. Why? The reason why is because whether or not the rate is going to be like 50 basis point, 25 basis point, whatever the Federal Reserve going to say, right? All these are open numbers. All the Federal Reserve all the smart money, every single one of them know this number already. So what's happening here is all the smart money, right? They are trying to use whatever liquidity that is coming in here to buy or to sell or to do whatever they want to do. Okay, they already know what they want to do already. They are just making use of the sudden liquidity to place their trade, place their position. The direction is already known by the smart money before then. It is just that at this point, for us retailer, we only now then know. So if we try to like place a trade with using this as an entry, right, you might get whipped left and right. It's kind of like slowing down, but the thing is that we still need to wait for the Federal Reserve to speak. Maybe when they speak, there will be more information. But the 0.5 is expected, the market pricing ready. And another thing is that this is the first time we ever have a 0.5 increase in rate since the housing crisis, which is like 14 years ago.
Don't want this Fed to have to face.
I'm not gonna overthink that, John. I'm gonna look at the partition here. You know, given the supply shock you talk about and the continued shocks, the China lockdown, or the separation of domestic and foreign economics for America. Someone to partition that for us and to expect the unexpected is Scott Miner, Guggenheim Global CIO. Always controversial, always interesting, ready to take notes. Dodgers strong this morning. For those of you on radio, Mr. Miner, very much LA Dodgers right now. Scott Miner, I'm going to cut to the chase. We have to expect the unexpected, and that always speaks to the bond fixed income system. What will the price of bills, notes, and bonds do?
Well, I think right now, Tom, we're actually coming to near a peak. When you see how much we've backed up, we're from where our models sit, we are now 5 standard deviations away from our predicted level for rates. That tells you that we're like 1 in 3.5 million probability of getting to this level. We're really overextended. And I think that the Fed, with its inflation fighting, statements here, that it's very, very hawkish. They're being very, very aggressive in terms of both shrinking the balance sheet and raising rates, that the market is going to have confidence that they're going to overcome the inflation problem. The real question in my mind is, going back to the 1930s, We have never been able to reduce inflation by more than 2.5 percentage points without inducing a recession. So even if we don't get close to the 2% target, it's very likely that we will have some kind of an economic slowdown well before we get to the desired inflation target.
When we see the trade balance today, that's the kind of shock that's almost exogenous to the zeitgeist out there. What items are you looking for, Scott, that feed into you this recession call? What are the things that matter to get to a true contraction?
Right. Well, Tom, it's interesting. Everything we talk about, and you'll appreciate this, we keep talking about the rate of change. And the rate of change is obviously the first derivative. But I don't hear people talking about the second derivative. And that is, what is the deceleration that's occurring in various...
Still very volatile. Let's go back to March period and see how was the price action like. This one is very sideways. Okay, if you look at it, it does seems normal, because we do have like all this kind of similar price action on a normal day. On a normal day, there's no rate hike or what. Even here, on a normal day, so it does seems like a normal price movement lah. Let's head back to March period. Here, this one. This was the March period, the March high. Shit, how far do I have to? Can I not just shift to 1 minute? No, it will shift me back to the current. So lame. Okay, never mind. It's too much already. I'm not gonna look at it. But I mean, if you look at on a 15-minute time frame, right? It's like a normal candle lah, like what you see here lah. What you see here on a normal day. This was on the 2nd May. So what's going on 2nd May? I think 2nd May was, I don't know what's going on. I forgot already. Forgot what's going on. But it is a lightsaber candle lah. Okay, lightsaber candle. Like if you are a short time frame trader, you short also die, long also die. That kind of. It's just trying to flip people out in order to churn as much liquidity as possible. They already probably have a direction already, but in order to get as much people to hop on, right? They are trying to like kick people out and then take their liquidity lah.
Very clear statistically when you're talking about probabilities of over 1 in a million that you're still in a trend.
So you can see here they want to do a balance sheet reduction at the rate of 47.5 billion per month. They are going to sell 47.5 billion worth of treasury per month, which is it's hard to gauge whether is it aggressive or whether is it considered normal. I think that's probably what the market not very like is trying to figure out also. Because the issue here is that this is the first time Federal Reserve have so much balance sheet, like I don't know how many trillion worth in their balance sheet lah, and I think even they themselves, they don't really know what is a good amount. So it is, I would say, uncharted waters lah. No one really know what's going on. Not even the Federal Reserve know. It's still trying to settle down. let's go and see how the techs are doing. Okay, let's go and see how the techs are doing. Pool Corporation recovered though. Pool Corporation recovered. AMD, yeah, AMD kind of like swing left and right during that period. Google actually suffering. It actually came down. So sad. Amazon came down. Apple. Most of them are at the lower end. Facebook at the lower end. Most of them are at the lower end. How about the banks? Okay, so it is the bank that is kind of like saving the index. The banks are okay. Banks are doing okay. We can see the Nasdaq, though you can see the Nasdaq already at -20, but S&P is still slightly green. So you can kind of tell that it is the tech that is pulling everything down. But for S&P, the financial is like kind of a saving grace lah.
Breakfast this morning with a major investor in private equity. And he was telling me he thinks, we're going to have a tough go for the next 8 months or so in stocks, but ultimately we're going to come out of this and do well. I'm always skeptical of the consensus views. The view today is so bearish on stocks, so bearish on bonds. Every time we get this far out of consensus, it seems that the opposite direction is the way to go.
Scott Miner with us on Bloomberg Radio, Bloomberg Television, John Farrell, Lisa Brown, and myself.
Okay, so they released some stuff already. Okay, so this is the Federal Reserve actual website. So let's look at what they mentioned. Although overall economic activity edged down in the first quarter, household spending, business, fixed investment remains strong. Job gains have been robust in the recent month, and the unemployment rate has declined substantially. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. The invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for US economy are highly uncertain. The invasion and related events are creating additional upward pressure on inflation and are likely to weigh on economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate, don't know how to pronounce that, supply chain disruption. Committee is highly attentive to inflation rates. Okay, so they are highly attentive to inflation rate, which is why we have a 50 basis point move lah. If not, they will have a 20 basis point move. Committees seek to achieve maximum employment and inflation at the rate of 2% over the longer run. I think 2% is quite hard to achieve this year. Maybe only next year then they can achieve. With appropriate firming in the stance of monetary policy, committee expect inflation to return to its 2% objective and the labor market to remain strong. In support of this goal, committee decided to raise the target range for federal fund rate to 0.75% to 1% and anticipate that ongoing increase in the target range will be appropriate. Ongoing increases. What do they mean by ongoing increase? Oh my God, it's like going red now. In addition, committee decided to begin reducing, they are going to reduce holding of treasury security and agency debt and agency mortgage-backed security on June 1st, as described in Plan for Reducing Size of Federal Reserve Balance Sheet that were issued in conjunction with this statement. In assessing appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for economic outlook. Committee will be prepared to adjust the stance in monetary policy as appropriate if risks may emerge that could impede the attainment of the committee goals. The committee assessment will take into account a wide range of information, including reading of public health, labor market condition, inflation pressure, inflation expectation, and financial and international development. Okay, so yeah, I mean, is basically what we see lah. But let's take a look at the plan for reducing the size. Okay, these are a bit chim. So for treasury security, the cap will initially set to 30 billion per month, and after 3 months, it will increase to 60 billion per month. The decline in holding of treasury security under this monthly cap will include treasury coupon, okay, blah, blah, blah. Okay, blah, blah, blah. What's the MBS? For agency debt and agency mortgage-based security, cap will initially spend. Okay, this is not really very aggressive. It's not really very aggressive. Previously, they were buying like 80 billions of treasury per month, but now they are only going to start at 30 billion. And then after 3 months, then they will increase to 60 billion. But I mean, it is still a reduction nonetheless lah. So on top of the rate hike, right? This is additional pressure lah, because when you sell treasury, right, you are removing money supply from the market. So we do have going rate ready. That's such a big red candle. Nasdaq is going to almost minus 1%, 100 points. it's the tech fault. It's all the tech fault. Confirm very lively here. Let's go take a look what they are doing. I like to look at the futures volume. Okay, futures already closed. Excuse me, sorry. Okay, don't mind the green number too much. Okay, just look at the price, which is 4188. Excuse me. I mean, the volume isn't a lot. It is like any normal day volume like that. If I look at this volume like 1 year later, right, I wouldn't even know like there was a federal rate hike today. There was a rate hike today. This is the CMC volume. CMC volume a bit, I would say not that accurate lah, because it's CFD volume. But you can see it's still very volatile. It's still it's swinging so much. I got puts and calls. I'm ready. Give it to me, Daddy P. Later, Jerome Powell will come out and say all the, like, we are going to use our tools. Fed stance is bearish. They don't seem to. Okay, so I mean, even though everything that have been mentioned so far is like bearish, right? The thing is, all this information are not new. Like the market know all this already. They have been already saying this sometime since like around early April, mid-April, like that. All this information are known already. So when they come out and say this, right, it is like, okay, like everyone know this already lah, especially the 50 basis point rate hike. But I can tell you that if it is something that is extremely aggressive and it is something out of the ordinary, like for example, they raised by 75 basis point, right? I can tell you this one is gonna just jump all the way down. So the kind of volatility that you are seeing here, right? It is normal. It is normal volatility, okay? It is just that because of this event, right? The volume is being churned up. So like don't really have to care too much. In fact, if you look at this, like 10 years later, I give you a blank chart and I want you to point out where is the Federal Reserve hike take place, right? You won't be able to point out on the chart at all, because like the movement is, there are other times where the movement are a lot more volatile. But I do want to listen to what Jerome Powell is saying though. Is he speaking really or not? In 24 minutes. These guys are from London. They don't want to sleep also.
Wherever it would head, given economic contraction, speaks to the politics of this Fed. You and I have studied McChesney Martin, Truman. I believe it was McChesney Martin and LBJ again in Vietnam. How political does Powell have to be sensitive to the Washington process?
Well, I think, Tom, that they're demonstrating right now that they have to be highly sensitive. The uproar over price increases and the pressure they're feeling from Congress, I think, is causing the committee to be maybe more aggressive than they normally.
Surprisingly, not much movement in gold though. Not much movement in gold, not much movement in the dollar index. I would think a 50 basis point will create like one big candle in the dollar index or gold, but it didn't. So I mean, it seems that it has been priced in. It has been priced in really. You can also see how much gold went down recently. Like it started going down from like 19 April all the way down. And if you look at the S&P, right, it is about the same period. It is here, where the Federal Reserve announced the 50 basis point somewhere here. 19 April is somewhere here. Yeah, this candle. About the same. So I think for gold also pricing ready. Shit, man, I think should have shorted gold back there. I mean, together with the market. I mean, like you short gold, short market, they are in the same direction. So if, as long as you got one, I think you are good. So sometimes you can see that there are some correlation between stock market and gold. Sometimes the correlation doesn't happen. So it is not always that stock go down, gold go up, or it's not always this down, that up, that down. Sometimes they can decouple. Sometimes they can go together, especially for example, oil and gas together with stock, right? Sometimes they can go together, sometimes they can decouple based on whatever the macroeconomic condition is. And same thing with the bond yield. Sometimes when the bond yield go up, stocks come down. And there are sometimes bond yield go up, stock also goes up. So they tend to couple and decouple based on what the current macroeconomic condition is. And it is something that I personally, I'm aware of the phenomenon, but I'm not really sure at what stage do they go together and at what stage do they decouple. So it is very important that when you are doing analysis, especially on stock market, right, you cannot simply look at one parameter and just simply decide that this one up means that one down. That totally not how stock market work, because if that kind of thing works, right, everyone will be a billionaire already. Like you simply need to look at one parameter and then if this one up, stock market up. But in reality, there are like 1,000 parameters that is affecting the stock market. And sometimes certain parameters have a higher weightage in certain situations. And that's what makes the whole market very, very hard to predict. Nice, recover already. This is called part of stop loss movement. This is a historic 50 basis point. Yes, correct. So for all the young folks, young folks lah, or those like millennial, Gen X, Gen Z, right? Congratulations, you have like, I mean, you have experienced a few moments that are historical lah, okay? So we have 150 basis point movement in the past 20 years. So if you are less than 20 years old, congratulations. This is your first ever 50 basis point hike. I think that there are a lot of historical moments I personally have gone through also. For example, 2007 housing crisis, right? I mean, I wasn't trading back then, but I was aware of it because that time, right, I was already working. And at that period, right, what happened was that my workplace, which is called Baxter Healthcare, it is a US pharmaceutical giant, and they offer stocks option for employee lah, okay? So whenever we have a quarterly company-wide meeting, right, they will talk about the stock option, and then they will like share the company stock price and just like do all kind of sharing lah. So during 2007, 2008, I started working there already, and I remember this period where during the quarterly meeting, right, like the mood is very bad. Everyone is down. The company CEO is like down because the company stock crashed about 40 to 50% like that. And that was when I first saw the chart, when I first saw the candlestick chart. It's going back to negative. And then for Forex, right? Forex, there was also a very big historical movement where the euro got depegged from Swiss franc, and then it caused a lot of panic. It's like there were a lot of people got bankrupt, I believe, during this period. It was horrible. Oh, he's speaking already.
In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continue to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services.
The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in forming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels. Assuming that economic and financial conditions evolve in line with expectations, there is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, so we have a few extra information, and that is going forward, right? We probably are going to see additional 50 basis point hike, okay? So currently we have 50 basis point hike from 0.5 to 1.0. So the next one in June, is it in June? So fast. Yeah, in June it's gonna be another 50 basis point hike to 1.5. So it seems that this 50 basis point hike for all the remaining years, right, is probably priced in by the market also. So you can see when he start to talk about that, right, market kind of like a bit wobble, but it is still maintaining that it doesn't shoot down all the way like that. How on depend, like for example, right, if you look at previously here, right, it just went all the way in one direction now when the direction is clear. But in our case right now, right, it just seems that everything is slightly neutral, like nothing is nothing is really clear. But it does kind of shows that that have been priced in. Like the market kind of already expect Federal Reserve to go 50 basis point for the coming years. Okay, so you can truly see how crazy the price swing is. It is different from all this kind of situation because like they move in a gradual manner, but this is like within the short period is just swinging up, down, up, down, up, down at a very extreme pace.
Really, the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was
your level of confidence that you can still hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up.
Crazy! Look at the look at the price movement. So are we settled now? Can I sleep? Can this stop moving so I can sleep? Okay, let me put an alert here. Okay, let me put an alert here. If the price go below here, I think is I don't know I don't know. I mean, just alert Okay, it's not my stop loss It's just to alert me that certain level has been. I mean, this level is a 15-minute chart level. Okay, so don't depend on it too much. Seriously ridiculous. It's ridiculous. Let's see how the banks are doing. The banks are doing very well. The banks are doing very well. PayPal should not even be here. Banks are doing very well. Like the banks are going green really. It's the tech. It's the tech that is pulling everything down. It's kind of funny though. I mean, like we like just 2 weeks ago we hoping Amazon crash and burn, but now like please go up for the next 2 weeks. But I mean, this the beauty of trading individual stock. You have all these counter that goes up, good for the index. We are on the index, but you still have counters like this that is still diving down. This is totally divorced from the market itself. And then we also have counters like this that don't really care about whatever the interest rate is doing. It's just moving by itself. And we also have counter like Hershey also, just very steady uptrend. Okay, to be fair, let me put a alert above also.
Evolve in ways that are consistent with that.
So normally after he say his stuff, right, he will have a Q&A session. So normally Q&A session don't really have anything that kind of push the market so much. Okay. 50, 75 basis point isn't something FOMC is actively considering. So you can see the moment this statement come out, like it suddenly show up already. Okay, so we are 75 basis point that is like, okay, like no more. Okay, so we are pretty safe. Okay, so market truly like this. So it's good to understand the whole dynamic lah. So at least like if you look at this without having any idea what's going on, right? You're probably gonna scare. You don't know what's going on. You might prematurely exit your S&P position, all this kind of stuff. So this kind of knowledge are good, and I think you should take the effort to get familiarized with whatever nonsense FOMC is doing, like especially Jerome Powell and his tools. So this website, FOMC website, is actually very good. Actually, for my course, right, we frequently come here and we will look at some of the key information whenever the dates are out. Okay, so do pay attention. Because you will know how to properly sort of predict market direction, not really predict, but kind of expect how the market to respond to certain things lah. Okay. Let me check my CFD price. Wow. Shock. If it goes 4330, will be even more shock. Nice.
A judgment call when these meetings arrive. But our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table the next 2 meetings.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting?
Unless he say wrong thing. He keeps saying he want to use his tools lah, so I don't think he will say anything wrong. Most of the response during FOMC meeting is quite well crafted. So I think they are very well trained on not to say things that will spook the market. I mean, in that aspect, right, I kind of trust Jerome Powell. He is not Donald Trump. He is not Elon Musk, where anyhow tweet something that just shoot the market left and right like that. so I think we are kind of like fit for the day, ready. Nice. Market recovering ready. 50 points, 1.2%. Let me share my current position. It's my Tiger position. So you will see some trades missing from my Tiger because I have several accounts lah. But most of the stuff are there. Wait, I will post in the chat. So for Tiger, I tend to use it for all those short-term YOLOing nonsense, all those kind of stuff. Hey, crap.
policy rate up to ranges of more normal neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina. Thanks, Chair Powell. Gina Smiley with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so we our tools don't really work on supply shocks. Our tools work on demand, and to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So
gold is gold is rallying. Gold is rallying. USD is dropping. But I mean, right? USD dropping is actually very good for stock market. Mainly because a lot of US corporation, right? If you think about things like Apple, where this company relies a lot on overseas sales, right? A strong US dollar is very bad for their earnings. In fact, sometimes due to this very strong US dollar, right, their earnings can actually reduce by as much as like 15% like that, or even 20%. That's actually quite a lot, depending on how much of their sales is coming from overseas. So usually lower US dollar tend to be good for the stock market. And if this decide to go down, right, it can probably give the market a boost. And now gold is recovering also. So it does seems that everyone, Federal Reserve did what everyone expected, and we truly hit a oversold level, and now market is pricing in all the new information and is recovering now. Okay, so before anyone get too excited, right, this is still a dead cat bounce. Okay, this is still a dead cat bounce. All the inflation negative GDP all the housing bubble, all those are still there. All those suddenly doesn't disappear because of one FOMC meeting. Okay, so what we want is we'll probably want to catch until 4300, or maybe if the momentum is still strong, we try to catch until 4400. And if at some point when market decide to swing back, right, that is where we will resume our shorts. Okay, so it is just that right now we have very little counter to short because of the fact that the price have already dropped so low. So instead of sitting around and waiting for things to get served to us, right, we have to take the initiative and go and do something, go and look for other trades. And since market is rebounding, right, why not take the rebound trade also? So for example, yes, in trading we have a lot of rules and stuff, but sometimes we of course need to know, sometimes we need to break them because of certain circumstances. That's why trading cannot be too strict where you have this rule, that rule, then forever want to follow this rule. You won't be successful. So you have to really know when to sort of switch certain things around and make sure you are making very good decisions. So all this thing, right, you are not going to immediately born into the world with all this knowledge. It is something that you pick up and learn along the way. Definitely you are going to make a lot of mistakes here and there, but with time, right, you will get used to it, you will learn and you will get used to it. Of course, with me providing this kind of session, this kind of live situation, right, it can increase your learning curve by a lot faster. So that at least you know what you are doing. The most important thing is you have to know what you are doing. Before you make a trade, right? Even as simple as a long position like this, right? You have to sit down and ask yourself, why am I going long position? So for me, number one, market is oversold. Number two, most likely Federal Reserve is gonna raise by 50 basis points, but whatever, anything beyond that, right? I don't know. So that's why we have a question mark, question mark. We cannot trade with every single information known to us. That is impossible. So that's why we still need to make sure that our risk is properly managed lah. And then we have a proper stop loss, and then we have a proper trade plan. And once all those things are settled, right, you also need to ask yourself, why am I going long? It's like, am I not putting enough effort to find shorts? But actually I have about close to 15 counter that I want to short in my watch list. It's just that they are not at the proper price level where I can safely put a short. So I have actually put in the effort to go and find short really. It's just that I cannot find one that I can short right now. So these are the kind of thing that you truly need to be very, very clear lah. And if you just simply go and long here because someone somewhere say market can recover, go up, even if that person is right, what's gonna happen is you see this kind of price action here, you will confirm get freak out and then exit, or end up you might cut your loss here, run, and then you end up losing big, and then market just rally without you. Going 70 points. Nice. You see Nasdaq. Oh my God. Nasdaq recovered 106 points. Let's take a look at it. Pool went back to positive. Holy crap. Fastener is at 4%. Oh my God. But never mind. It's okay. Just let them be. So let's say if we do not have a long position right now, right? What's going to happen is we are going to eat all these paper losses, all these so-called unrealized loss in our profit, and then you will feel very not very good lah. Oh, market rallying, now my short position are like this. But when you have a long position that you can take profit on, right? You realize that actually you hold all these things is okay one. Just let them be while you are making profit from the other direction temporarily somewhere else lah. Facebook is just shooting up. the other day I cut my loss here lah. So end up my original position loss about 2K like that lah. It was it was slightly more loss than I planned for. Alphabet. Wow, DoorDash was minus 10%. Now it is like this. I think DoorDash just now was minus 10%. See, about minus 10 now it's like positive really. Ridiculous. And you can see on counters like this, right? You see this one small candle here, like nothing like that, but that candle is actually 10%. Starbucks going to 10%. Holy crap. At least AMD is recovering now. At least AMD is recovering. Okay, so we are on a very good bullish recovery for now now. Okay, so let's hope that when it hit 4300, it doesn't suddenly reject down. At least while we are in position, right, we can go to 4350 or 4400. Then we TP on our position here. And then after that, we replay our long. Okay, so for counters like Pua, Fastener, don't be too worried about them. Just let them be, leave them, let them work out themselves. Like for example, if I show you Starbucks, right? Previously Starbucks, you see this rally here. I held my position through this rally, and that rally was when S&P went up all the way here. S&P from bottom went up all the way here. So when market rallying like this, right? If you choose your short position, if you should choose your short trade properly, they will recover. They will recover, but they will not recover until like it hit your stop loss like that. They will just recover a bit and then hang around a bit and then start to go back down again. So, and while your short counters are recovering because of some broad market rally, right? You go and long something to make up for it and to get that extra profit along the way lah. So you are not like idling around. Okay, so I think that's about it. We are on S&P 500. 71 point within the intraday. So congratulations for all those who have your S&P trade. So I'll be closing off this session. It's 3 a.m. right now. All of you crazy people still here. Go and sleep. Okay. Have a good night or good morning. Let's look at what earnings coming out later. I don't think there's an we have Shopify. We have Shopify coming. We have Chemical coming out. But Chemical cut already lah. Shopify coming out, Datadog, Crocs, and Wayfair. These are counters that I have knowledge on lah. But yeah, let's hope Shopify move up so that we can short at a higher price lah. Okay, have a good night, guys. Bye bye. Sleep. Go to sleep.